Let's begin with a simple question. What actually happened? Like when you deposit money in a bank, like most people believe something very straightforward. You earn money where you go to a bank, or you deposit it, and the bank keeps it safe for you. That's the mental image we all have. A vault, your money waiting. But in reality, that's not how modern banking works. Let's take a simple example. You deposit $1,000 into your bank account. At that moment, your balance shows $1,000. And from your perspective, everything feels normal. But inside the banking system, something very different is happening. Your $1,000 is not placed in a separate box with your name on it. It is not sitting still. Instead, it becomes part of a much larger pool of money. This pool includes deposits from thousands of other people, salaries, savings, business income, all combined together. Now, let's introduce another person, someone who needs money. This could be a small business owner, someone buying a car, or someone taking a home loan. They go to the same bank, but instead of depositing money, they request a loan, and the bank approves it. Where does that loan come from? It comes from that pool of deposits, which includes your money. So, in a very real sense, the money you deposited is now being used by someone else. This is the core function of a bank. It connects people who have money with people who need money. But this is not done for free. The bank charges interest on the loan. Let's say the borrower pays 8% per year. At the same time, the bank pays you interest on your deposit, maybe 2% or 3%. So now we have a gap. The bank earns 8% and pays out 2% or 3%. That difference is how the bank makes money. Now let's step back and look at the bigger picture. This process is happening continuously. Our deposits come in, loans go out, payments come back with interest, and the cycle repeats across millions of people across the entire country every single day. This is what keeps the financial system active. But there is another important concept we need to understand. Banks do not keep all deposited money in reserve. In the United States, banks operate under what is called a fractional reserve system. This means they keep only a portion of deposits as available cash and lend out the rest. For example, if you deposit $1,000, the bank might keep only a small percentage and lend out the majority. Why is this possible?